Of course, the overall topic is decarbonization and the effort to decarbonize the world's economies. And as part of that effort, I have been doing some work, and so has Bob and Karthik, on the very topic of corporate carbon accounting. We believe there is actually currently a lot of innovation underway. Different stakeholders, from regulators to the companies themselves to consumers, have an interest in more reliable carbon accounting figures that are reporting on the emissions companies have actually incurred and will incur in the future. And that is sort of now a field that is really just emerging for both academic research, but it's at the same time being formed in practice.
My research with Karthik is very complementary to what Stefan has done, both complementary with an I and complementary with an E. Let's do particularly the E complementary, is that Stefan has focused on the accounting that goes on within a firm and how it can better measure the carbon as it goes through from inputs to outputs in a firm. And the work we've been doing is between firms, because for the great majority of companies, their own emissions is a very small fraction of the total emissions that they have some influence on. The average company, the own emissions, called Scope 1, is maybe 15% of the total emissions. What are the remainder? Are the emissions that are in its supply chain, in the products and services that they're purchasing and the emissions used to produce those products and services. And so the interesting challenge has been, how do you move that information from supply chains into the company and then make it susceptible or available for the type of accounting that Stefan has been doing, but then using that information to transmit the carbon information in the products and services that a company sells to its customers. And that enables that information to continually flow down even the most complex supply and value chains. Relating to this conference, and I may start in our public presentation, that accounting should really be both technology and policy agnostic. I don't have a stake in any of the technologies that should be adopted or really which policy. But I will say it's difficult to make decisions about technology and policy in the absence of good data, measurements at the micro level that we're trying to provide. So we see this as very important, necessary inputs into choices about technology and choices about policy. But the accounting should really be agnostic with respect to those choices. Now, I have personal preferences that I could express, but they're less well informed than the other speakers at this conference who have lots of expertise in both technology and policy.
I think one immediate policy angle of the work that we're doing is that regulators in many countries are sort of beginning to now say, what we have seen in the past from companies in terms of reporting on their carbon emissions ought to be improved. There is really a lot of scope for innovation and improvement there. And I think companies, in turn, the corporate sector, in anticipation of that movement, is now becoming increasingly serious and focused on developing procedures that underlie this carbon reporting. And that is one of the policy angles that I think we have in the back of our mind as we're doing this work.
Yeah. So let me build on what Stefan said. I was talking about kind of technology and high-level government policy, and Stefan and I have to deal with accounting policies and what they should be. And one of the implications from my work is that the current kinds of policies are standing in the wrong place and looking in the wrong direction. They're looking at a point of view from a downstream company and asking them to look upstream to all of its suppliers to get the information. In the system we're proposing that we call e-liability accounting, we want a whole system of which all companies are participating in the system. And by making this assumption that it's a system-level approach rather than approach being mandated to individual companies, you actually start with the original suppliers of raw materials or agricultural products or fossil fuels and work your way up. And so what you do is have companies, rather than looking backward in their supply chain, is assuming they're going to get information from their suppliers on the carbon content and look downstream to their customers and send the information there. So the whole direction of where they're focused, instead of being, how do I extract information from suppliers, many of whom I don't even know who they are, is to take information I will assume I get from suppliers because of the regulation and policy that we advocate for, process it with my own emissions, own company emissions, and then my obligation is to report downstream to my customers. That sounds like a kind of a trivial change, but it's really a very powerful change in orientation.
Well, and if I can add to that, it's important, powerful, essential, not only because it leads to a system where we're dealing with actual measurement of carbon emissions at different stages of the supply chain, but the implication of doing that is really profound in terms of ultimately the incentives companies have to reduce their emissions. In the current system, much of what we're talking about and what we're proposing here is really being farmed out, contracted out to outside consultants that are relying on broad, average, industry-level data. You can do that, and you can say then it works on average, but the implications are profound for when it comes to the question, should a company reduce its own emissions? How much should it lean on its suppliers to reduce their emissions? Because in the current measurement and reporting system, any improvements will not be reflected in a long time, if at all, in the numbers that the company reports.
And to illustrate exactly what Stefan just said, is when you do this, you learn that what are currently thought of today as commodities are no longer commodities. A specific example I'll illustrate in my talk at the conference is a company that makes electrical transformers. And the primary material in a transformer is copper wire. And they were under great pressure from the environmental activists and community to use more recycled copper. Recycled is good, virgin is bad because you have to dig it out of the ground and use energy. But the company's engineers believed that actually the copper, original copper that they're getting from a company with a mine in northern Sweden was actually very low carbon. And they went through and did the study, and they found out it was a very rich ore. You get a lot of copper ore for a shovelful. It was a completely electrified mine. And the electricity comes from hydropower in northern Sweden. And we traced it through 4 levels of the supply chain. We found that that copper, virgin copper coming from the mine, had 1/3 the carbon content of recycled copper. Because if you did the same calculation for recycled copper, that comes from incinerating printed circuit boards, which generates, a lot of emissions. And so who knew that? But in addition, the mine in northern Sweden was not enough to supply all their copper needs, so they were also using copper imported from a South American country, which was a very inefficient mine, very low copper ore per shovelful. It was powered, they used some fossil fuel machines, and whatever electricity they used came from coal-fired plants, and they had to transmit or distribute the copper from South America all the way up to Northern Europe. And that was carbon content was 3 times the recycled copper. So in just this very simple example, who knew copper was copper? When it shows up, it has the same performance, same functionality, but there was an order of magnitude difference in the carbon content between the copper coming from the northern Sweden mine versus that coming from South America.
And in the traditional way of
there'd be an
reporting,
average
that would
emissions factor.
never be picked up.
Copper has some average emissions factor, satisfies Greenhouse Gas Protocol Scope 3,
Done.
letter, and there's no incentive. Now they have an incentive. Yeah, let's shift where we got copper from. Let's give more capital to the mines in northern Sweden to where we can extract much more of that low carbon copper in a very efficient way and reduce our reliance on inefficiently high carbon copper coming from distant locations.
If I could sort of add to this, everything we have been discussing here in this conversation is at some level perfectly natural to accounting and to accountants, because if you sort of think about the financial domain, both financial accounting and also management accounting, how does it work there? And so the question that really I think sort of we have been wrestling with in recent years is, why has the reporting for carbon emissions sort of evolved the way it has, as opposed to taking advantage of the relatively time-tested, well-thought-out system of financial and financial accounting primarily, taking advantage of that in terms of an innovation and in terms of adaptation ought to be the natural way to go. But this is sort of a transition that I think we're beginning to see. There are quite a few companies, in particular European companies, that have been innovative in this domain and are actually going down the direction that we're advocating for.
So again, building upon Stefan, where the European community is going is wanting to reduce the carbon emissions from European production. But what they don't want is to reduce those emissions by outsourcing the production to non-EU regions of the world. First, it hurts the European economy, and second, it does nothing to reduce global emissions. The atmosphere doesn't care which continent the emissions come from. So Europe is considering a mechanism called CBAM, Carbon Adjustment Mechanism, that will put a tax on products coming into the EU with high carbon, based on the carbon. Well, to do this, you have to be able to measure the carbon content. And this is where the accounting has to be the foundation for any type of policy, regulatory policy or tax policy. Now, the challenge is the producers in other parts of the world may say, well, I'm not going to tell you. There's no obligation for me to tell you what the carbon content is. Now, if you default to the greenhouse gas standard, it says, well, okay, in that case, we'll use the industry average of that. Well, as my example from the South American mine illustrates, the industry average is not a good measure. And so we advocate, I'm not sure Stefan is on this, but he can join in, is to say, if you are importing materials where you don't have accurate audited data on the carbon content in those materials, we're not going to use the median of the distribution. We're going to use the 95th or the 99th percentile of the distribution, assuming that there's some reason you're not telling us this and giving us good data. And so as suppliers in these other regions realize that their materials will be taxed at the upper end of the distribution, getting back to incentives, now they have incentives that, no, we're not at the 99th percentile, we're maybe at the 63rd. You say, okay, well, show us, give us the data, give us an assurance, an audited document, and then we'll use that data. So even without adoption in all the other parts of the world with regulation, you can design the CBAM so there's an incentive, A, for accurate reporting, and B, for the companies in Europe to seek lower and lower carbon intensive products and services from their suppliers, which is exactly what we want.
And I would add not only accurate reporting, but also certified reporting.
Yeah, when I said assured, assurance. Yeah,
assurance has to be part of that. And I mean, CBAM is a very good example that I think will provide an impetus to do the type of carbon footprint accounting at the product level that we're talking about. But there are other examples in other countries. So for instance, in the US, a major policy initiative has been the Inflation Reduction Act of 2022. And there, basically the government says we're providing subsidies, usually tax credits, if you make certain green products. So hydrogen would be an example, but there are others. You immediately get to the question, okay, I can produce hydrogen in a number of ways. Now, what is the carbon content of the kilogram of hydrogen that I've produced? So I need to document this, and then we're exactly in the same situation as we are with CBAM.
3 years ago, shortly after the publication of our first article, we did get an audience with a very senior financial regulatory agency in the United States and with the senior team from that. And we explained our approach, and they said, this makes a lot of sense. This is accounting. Getting back to Stefan's point, instead of accounting in euros or dollars, it's accounting in kilograms of CO2. But we're used to working in different currencies, and this is, in a way, like a different currency, but based on physical gases. And the senior people said, this makes a lot of sense. Who's doing it? And we said, oh, no one's doing it. This was once we saw this problem that existed, we realized that the existing approach was not going to solve this problem, but there was an accounting approach that would solve this problem, and that's what we wrote. And they said, well, that's very nice, but we can't require companies to use a standard that no one has ever tried. So I said, no, you're perfectly right. It's up to us to start to find organizations that are willing to try it out, adopt it, see the properties, and see how it works. In fact, that's how Stefan and I got connected, because Stefan was already working with a very, very large cement company, which is about the most polluting material we have. If cement were a country, it would be third behind China and the US in emissions. And we were able to demonstrate with several companies that did work with us, the cement company, the tire company, the electric transformer company, automobile companies, and quite a few others, that this does work. They didn't find it burdensome to do the calculations. The one barrier they have, and we had this, is they couldn't get the right information from their suppliers. Many of their big suppliers would say, we don't have to tell you this. There's nothing in the greenhouse gas protocol that forces us to give you accurate, auditable information about the emissions in the products and services we're selling to you. So that's the barrier. And again, it's because the protocol has them looking backwards up their supply chain rather than forward to their customers and communicating that information. But that's easy to overcome. You know, once we get more companies on board, then I think that'll solve this. But you know, in the short term, candidly, we will have companies working within the framework really of Scope 3 in the Greenhouse Gas Protocol, because they're going to have to train their suppliers. They are going to have to look upstream and tell their suppliers, no, we're going to insist you give us this information. Here's what we expect. And that'll take a few iterations, because the suppliers then have to go to their suppliers and so far down. So it's not something we can just say, okay, in second quarter 2024 that we're going to do this. It will take 3 to 5 years to kind of get everyone in the whole system on board and producing this information using the algorithms that Stefan and I and Karthik have been developing. But we have a pretty clear picture of what the destination looks like. And what we have to do now is work back from the destination to what we want to be doing in the next few quarters.
So I must say I'm very optimistic that this new carbon accounting paradigm is materializing. And I would actually point to a number of examples of companies that have already been experimenting with an approach like this and have done what Bob just mentioned, sort of said, well, we can do this at the level of our company, but what about the quality of the data, the carbon emissions data that we're getting from our suppliers? So in some industries, and I mentioned in particular the automotive and the chemical industry being good examples, where companies have actually said, we are going to actively work with our suppliers to implement the same or similar systems as we have to do this product level carbon accounting at their levels, and then in turn push it up further. some of these companies have also become very explicit that when it comes to supplier selection in the future, the willingness by the suppliers to go in that direction and be part of that effort will be a criterion. In addition to quality, cost, and the carbon that is in those products. So this is actually a process that is, I think, gradually evolving. And one of the things that may sort of slow us down a little bit is the availability of enterprise software solutions, because that's what you need. If this is sort of at the level of spreadsheets, as it is frequently in the way of carbon reporting at the moment, it won't work. For large companies with a portfolio of thousands of products, this needs to be fully automated, but that's where we're coming back to really taking advantage of the infrastructure of financial accounting.
Yeah, so there are two key sectors that need to be brought into it, and Stefan just brought on the technology companies, enterprise software companies, and we are working with several of them. They like this approach for obvious reasons. This is a new line of business for them, and they see us as very doable because it's just an extension. And it's important to say that actually we could not have done this 20 years ago. We could do the accounting and we could have done the Excel spreadsheets, but the idea of taking information all the way up a supply chain and having it be accessible by a downstream company in a private, secure way requires something like a blockchain technology, which was not there 20 years ago. So this is one of the few really socially useful roles for blockchain, is to develop these. And so any upstream organization will be able to post the data. This is the data on this product. Here's the assurance document, the auditable document. And if you have the code, the access, the downstream customer can be able to look back up that blockchain and see where the data come from and the quality of the data. So that's a technology-enabled capability that just come on board in the last few years. The other key sector are the auditing and assurance firms. And so what are they going to be looking at in any given upstream company, or any company indeed, is they have to look at, are you taking in all the carbon emissions from your input products and services? Are you adding to it your own Scope 1 emissions? How are you assigning this to your output products? We don't want that to be biased and say, these products I'm selling to environmentally sensitive customers, I'm not going to allocate any emissions to them. And these products are customers who don't give a damn about the carbon emissions, so I'll allocate to them. No, we don't want that. The emissions have to be neutral based on the underlying chemical engineering or production process, and that has to be audited to know that we are getting valid data. So those two features, both the technology companies to move the information from one all the way down the supply chain, and also the assurance documents accompanying that data.
And to add to that one more time, so if you ask an auditor to certify that a set of statements were calculated and submitted in accordance with certain standards, the auditor, of course, in the area of carbon accounting say, so what are these standards? What's sort of the equivalent of a generally accepted accounting principles? And here I think one of the things that once again makes me optimistic, different industries have been very proactive in terms of industry associations to say here is basically a set of rules to the issue that Bob just talked about, say, of making sure that allocations are not biased, in particular if we're breaking this down now to individual products and the carbon content in individual products. That is sort of coming together in different industries. I think one of the interesting things to be looking for is, can we get this sort of fully standardized across the whole economy, or are we going to have sort of carbon accounting standards that are more industry specific? I think either one might work. It becomes a little bit a question of different trade-offs that at the end of the day will have to be.
I mean, my vision is in financial accounting, we have kind of generally accepted accounting practices, slightly different from the US than the rest of the world, but they're not that industry specific. Each industry may have specific issues that will require technical guidance to operate within this system. But I do think it'll be a uniform set. In fact, we're starting to draft what the principles could look like that would be economy-wide. So, we can be out. I think all the information is now available. We kind of know how to do this. We know what the destination looks like. And it's just really getting on a migration path to get there. But, we do have to overcome resistance from the status quo, who feels threatened and somewhat embarrassed, by the work that has gone on in the past. I mean, it was well-intentioned. It was directionally correct. Get your supply chain and make sure you do that. But I think, well, for whatever reason, they didn't come across the accounting solution that somewhat independently Stefan and I saw as being accountants, that how to think about doing this. One other thing we haven't talked about also is in the greenhouse gas protocol, we've talked about scope 3, and they think scope 2 is okay. Well, it turns out scope 2 is not okay. Scope 2 is really a special case of scope 3. And the problem we're having is we're letting the downstream company estimate the carbon content in the electricity it purchases. And that's led to certain somewhat not really valid processes that they're using. The information needs to come from the electricity company. They're a supplier, just like a steel supplier or a copper supplier. They should look at the carbon footprint of the kilowatts they're producing and report that to all the customers, and not have their customers decide, oh yeah, we want to buy the electrons that you produce by wind and not the electrons you bought from coal. And right now the electricity company says, okay, we'll give you a certificate that you own the clean electrons, and we'll push the dirty electrons to somebody else. That does nothing to reduce the carbon content in electricity generation. So that's one of the distortions that has emerged from the scope 2 type reporting, and not treating it as it's just like scope 3. Electricity and energy is something you're purchasing from a supplier, and it should follow exactly the same principles and rules. There will be some technologies. For example, you can't expect 50 million smallholder farms to supply you with accurate carbon information in the cocoa beans they produce. And so we're going to be using satellite imagery on looking at those farms. We're going to be using AI or machine learning algorithms to estimate the emissions of crops grown around the world. And the technology has emerged that we can probably do that quite accurately, or accurately enough, so that we will be able to trace the emissions from even smallholder farms for the agricultural products that they are producing.
What we have been talking about here, what we're advocating for, what we're seeing in certain industries, is really a development of the very last couple of years. So I can sort of point to a couple of pioneering companies that have really gone down that path that we have been discussing and advocating for here. That's not older than about 3 or 4 years. What's an interesting thing is, where is the impetus now coming from? In my mind, a large part of it is that there is a general dissatisfaction with the way carbon reporting has happened. And as the climate crisis intensifies, regulators are thinking of new mechanisms to really accelerate the energy transition. As that has happened, people have come ultimately sort of to the doorstep. Do we also need better accounting and reporting systems? But I would say this is really, it's happening right now under our very eyes, but it's a relatively recent phenomenon.
Someone at the conference yesterday afternoon expressed chagrin that the SEC did not mandate scope 3 reporting in its most recent disclosure, and they felt the U.S. had done that because of pressure from the bad oil companies and fossil fuel companies. And I don't think that's the case at all. I think the SEC did not adopt and recommend scope 3 because they saw the deficiencies in that reporting, and it was not a scalable approach that it could impose on all organizations. And the same thing happened in California, which was going to require very detailed emissions reporting. They had to pull away from scope 3 because of the inherent flaws in that approach, which are correctable. And I think they both knew that these solutions were coming along.
The question is when they
Yeah.
will be corrected.
Yeah, and let me just talk another thing that's coming up again in the conference, which is this tremendous agreement of we have to shift 100% electrical energy, and that's fine. I'm not going to argue with that. I said I'm policy agnostic, but let's assume that's so. The trajectory of how you get there is really important because we don't have enough transmission capability to move quickly to go to all electricity, even if you had adequate amount of sun and wind. And to build out the grid, what do you need? You need a lot of copper. You're going to need a lot of steel for the towers. You're going to need a lot of concrete. What does that mean? That's a lot of emissions that are going to be produced under today's energy sources to build out the grid. And that means a lot more emissions are going to come out early over these next 20 or 25 years. Is that the right thing? Is that the right time path? I don't know the answer to that, but just thinking, let's do massive building out of the grid will put a huge amount of emissions into the environment. I don't know how much, but I know we can measure it. And as we think about those trajectories, you better think about, you know, all the copper that has to be mined and the steel to be produced and the concrete that's got to be produced, the nickel and lithium that has to be mined for the batteries. And that has to be part of that whole trajectory because, you know, we're not trying to get to net zero industry by industry or country by country. We have to get to global net zero and get there on the best trajectory between now and 2050. And it's only with this kind of accounting measurement at the very micro level, you know, at the copper mine and the nickel mine, and the concrete producers and the distribution of these heavy materials to this parts of the world that we want to be on an emissions low path to that. That's what the accounting will give them the information to make that judgment. Well, I mean, I find it fascinating to learn both about kind of the policy that's going on and the technologies that are being deployed, because that has an influence in thinking about how do we supply the correct measurements so they make the right choices on both those policies and those technologies. And by being at this event for 2 days, I feel I understand those issues much better and where the technologies are going and where the policies are going.
Yeah. I mean, ultimately, climate change and fighting climate change is a collective action problem in which not only do different players in the world need to sort of coordinate what they're doing, but you definitely need improved understanding on what is technologically possible in so many years and what type of incentives does ultimately, this all has to be done in a market economy, in a regulated market economy. What incentives are required for the parties to actually implement these changes and adopt these technologies? Yeah. And that, for that, I think sort of a forum like this one is very useful because people are really contributing from their own angles, and then it's a question of ultimately sort of bringing that together. But you know, that will, for that, this conference was very useful.
Yeah, and I hope that the session that Stefan and I talk on will help inform the brilliant scientists, engineers, policymakers, and economists not to treat the firm as this little black box that's going to kind of be the focus of all this regulation and technology adoption, but think about just what Stefan has said. How do we engage the corporations in the billions of decisions they're making, you know, each year on their own technologies, their own suppliers, the design of their products and services to participate in this decarbonization journey? And so far, the companies have not been players in this because the information has not been correct and the incentives have not been really aligned to reward them when they do go on a decarbonization journey. So what we're saying is a company, you have to think about the tens, hundreds of thousands of corporations to be part of the solution. And good measurements will enable that to occur.